Welcome to our comprehensive guide on interest rates. In this in-depth video, we'll take a deep dive into the fascinating world of interest rates, exploring what they are, how they work, and why they matter to you. So sit back, relax, and let's embark on this enlightening journey together. Let's begin with the fundamental question: what are interest rates? At its core, an interest rate is simply the cost of borrowing money or the return on investment for lending money. It's expressed as a percentage of the principal amount and plays a significant role in both the macroeconomic landscape and our personal finances. Interest rates impact virtually every aspect of our financial lives, from mortgages and car loans to savings accounts and investments. They are the backbone of the global financial system, guiding the flow of money, influencing consumer behavior, and shaping economic growth. Understanding how interest rates function is essential to make sound financial decisions, whether you're a seasoned investor or someone just starting to navigate the world of personal finance. Now that we have a basic understanding, let's explore the two main types of interest rates: simple and compound. Simple interest is straightforward. It's calculated solely on the initial amount borrowed or invested. As time passes, the interest remains constant, and it doesn't accumulate over time. Simple interest is commonly used for short-term loans or uncomplicated financial transactions. The formula for simple interest is interest equals principal times rate times time. For example, if you borrow $1,000 at an annual interest rate of 5%, you would pay $50 in interest per year. Now, let's move on to compound interest. This type of interest is more dynamic. It's calculated on both the principal amount and the accumulated interest from previous periods. As time goes on, the interest can snowball, leading to substantial growth in investments or a heavier burden on loans. Compound interest is a powerful force that can significantly impact long-term savings and investments. It's commonly used in retirement accounts, savings plans, and other long-term financial instruments. Now that we understand the types of interest rates, let's explore the factors that influence them. One of the most critical factors affecting interest rates is inflation. Inflation refers to the general increase in prices and decrease in the purchasing power of money over time. When inflation rises, the value of money decreases, and thus, interest rates tend to rise to compensate for the diminishing value of money. To combat inflation and stabilize the economy, central banks may raise interest rates. Higher interest rates encourage saving, reduce borrowing, and slow down spending, which can help control inflation. On the other hand, during economic downturns, central banks may lower interest rates to stimulate borrowing and investment. Lower interest rates incentivize businesses to invest in expansion and consumers to take out loans for purchases, thus bolstering economic growth. Now, let's explore how interest rates impact both borrowing and saving decisions. When you borrow money, the interest rate directly affects the overall cost of the loan. Higher interest rates mean more expensive loans, while lower rates can make borrowing more affordable. So, it's wise to shop around for loans and choose the most favorable interest rate to minimize the cost of borrowing. For example, let's say you're considering two car loans, one with an interest rate of 7% and another with 4%. On a $25,000 loan paid over 5 years, the 7% interest rate would cost you approximately $4,300 more in interest than the 4% rate. Conversely, when you save or invest, interest rates significantly influence the growth of your money. Higher interest rates can make your money grow faster, allowing your savings or investments to compound more rapidly over time. For instance, if you invest $10,000 in a savings account with a 3% interest rate, you'd earn around $300 in interest after the first year. However, If you managed to find an investment with a 6% interest rate, you'd earn approximately $600 in the same period. Over the long term, this seemingly small difference in interest rates can lead to a substantial growth in your savings. Conversely, lower interest rates may limit your returns, making it essential to consider long-term financial goals and risk tolerance when deciding where to invest. To better understand how interest rates fluctuate, let's explore a real-world example of interest rate trends over time. In the past, some countries experienced periods of high inflation, leading to double-digit interest rates. During such times, borrowing became extremely expensive, prompting individuals and businesses to think twice before taking on debt. However, these high interest rates made saving more attractive, as it offered a chance to earn significant returns on savings accounts and other interest-bearing investments. Conversely, during economic downturns, central banks might reduce interest rates to stimulate borrowing and investment. Lower interest rates incentivize businesses to invest in expansion and consumers to take out loans for purchases, thus bolstering economic growth. One of the most compelling aspects of interest rates, especially with compound interest, is the power of compounding. Compound interest has been famously quoted as the eighth wonder of the world. It is the concept of earning interest on your principal amount and any previously accumulated interest. Over time, this compounding effect can significantly boost your savings and investments. To illustrate the power of compounding, consider two hypothetical investors, Anna and Ben. Anna starts investing $1,000 a year at the age of 25 until she turns 35 and then stops. On the other hand, Ben starts investing the same amount at 35 and continues until he reaches 65. Assuming a 7% annual return, Anna's investment will grow to approximately $170,000 by the time she reaches 65, while Ben's investment will only amount to around $144,000. The reason for this vast difference is the power of compounding, which gives Anna's money more time to grow. This is why starting early with saving and investing is so crucial. The longer your money has to grow, the more it benefits from the power of compounding. Central banks play a vital role in shaping interest rates and the overall economic landscape. In most countries, the central bank has the authority to set short-term interest rates through monetary policy decisions. When the economy is overheating and inflation is rising, central banks may opt to raise interest rates. This move makes borrowing more expensive, which, in turn, slows down spending and helps control inflation. Conversely, during times of economic slowdown or recession, central banks may lower interest rates to encourage borrowing and spending. Lower interest rates mean cheaper loans, making it easier for individuals and businesses to access credit and invest in growth opportunities. It's crucial to understand that interest rates are not only influenced by domestic factors but also by the global economy. In today's interconnected world, international financial flows, currency exchange rates, and global economic conditions can significantly impact interest rates. For instance, changes in interest rates in one country can attract foreign investors seeking higher returns on their investments. This, in turn, can affect exchange rates, trade balances, and the overall stability of the global economy. Armed with this knowledge of interest rates, you can make more informed financial decisions that align with your short-term and long-term goals. If you're considering taking out a loan, carefully compare interest rates from various lenders to find the most favorable terms. A small difference in interest rates can lead to significant savings over time. When it comes to investing or saving, consider the potential for compounding growth. Seek out investment opportunities with competitive interest rates and assess your risk tolerance and time horizon. Remember, interest rates are just one piece of the financial puzzle. It's essential to consider other factors such as fees, penalties, and the overall health of the economy when making financial decisions. Keep in mind that interest rates are dynamic and can change over time due to economic conditions and central bank policies. Stay informed about economic trends and interest rate fluctuations to make timely adjustments to your financial strategy. We hope this comprehensive guide has deepened your understanding of interest rates. If you have any questions or want to learn more about personal finance, feel free to explore our other videos.